Hi everyone, my name is Ahmad Ashrafi. Today we have someone that plays on the home team, someone that's in the real estate space, and we were just laughing about how when you talk to somebody that's in real estate, it's a conversation flows a lot more and easier. So I'm very happy you're here, Isaac. Thank you for being here.
Yeah, pleasure to be here. And it's very true. Sometimes when you talk to people from other industries, it's not as fluent and congruent. So looking forward to this.
Yeah, I actually famously say or consistently say, uh, once you learn the real estate game, I don't know why you do anything else. Like
Yeah, it's
once I learned that, I was like, why would I even go to retail, or why would I do this? Like why would I ever think of it? I want to be the landlord. That's it.
yeah. It's hard. It's hard. Once you get a taste of real estate, deal making, connecting people, the characters that are in it just make it so much fun.
Yeah,
It's hard to step away for sure.
for sure. So why don't we start by maybe you can explain a little bit who you are, your background, and let's start from there.
Yeah, sure. So my name's Isaac Sandoval. I'm managing partner of a company called Happy Capital. Also the fund manager for our existing first fund. We're a vertically integrated real estate investment firm. So we do everything from acquisitions, dispositions, the capital behind all the projects. So like debt and equity sources, and then vertically integrate all the business lines that kind of follow those projects. So think of you want to put up a multifamily property. We help you through our fund to be able to secure the debt. We help through private placements to raise equity or participate through the equity, and then fill up vacancies, do a little bit of asset management, bring in the right construction partners, all the way down to the material sourcing, flooring, things that go into the building. So we do everything from start to finish in a vertically integrated capacity. More than anything, we just like to impact great investors and connect with the great investors that are looking for new ways to produce returns and also impact the communities that we place our capital in.
Holy moly, that's a lot. Why did you decide to do vertically integrated, or how did it start, and then how did it morph into vertically
Yeah,
integrated?
so the company itself is kind of a byproduct of me being in the space. So I grew up actually on job sites. My dad's a ground up custom home builder, and so when I was a kid, I used to walk around the dirt and see him talk to people and just see how cohesive everything was from that standpoint. When I turned 18, decided to jump into the real estate space on the investment sales side, and then transitioned to the mortgage lending side, and then kind of got that bug that we talked about at the beginning, right? So started doing a little bit of investments myself, then realized, oh, there's a huge opportunity in this space to actually incorporate all of this into a cohesive business, as opposed to trying to figure out, okay, well, I can get money from this person. I could get, contracting work done from that guy. I could get material source from that guy, but everything has its hiccups and nothing is really like a perfect symphony to putting a deal together. And the guys that do it really, really well perform at such a high level that um, they kind of focus on a specific niche as opposed to building to scale. So the thought process behind our business is really to be able to reach out to that small time developer that's looking to scale, or that super seasoned developer that has everything figured out. They know exactly what roles to play, but they need a comparable team that can handle everything they can. And so that's kind of where our inception comes from.
That's wonderful. And I agree that real estate is a very competitive sport. I equate to that. And most investing is, but I think real estate, there's so many players and it's super competitive. And if you have the right strategy, you have the right team, you have the right execution, you can make a lot of money.
But yeah,
But if you
if you
have a
don't, you could
hiccup,
lose it all.
you can lose it all. So I I uh, I usually say that if you have a rich uncle, real estate can make them middle class pretty quick.
Yeah,
If you don't
that's
know
very true.
what you're doing. So, what are those like? You said you have two types of sponsors, let's say, that you
Yeah,
work with.
yeah,
The growing sponsor, and then the very seasoned sponsor that knows that their, let's say, their strength is construction, or their strength is, I don't know, lease up, whatever it might be. you help them on everything that else is auxiliary. How do you know which sponsor to work with?
That's a great question. So, every single relationship that we starts the same exact way. It's usually over a cup of coffee or cafecito, which is what I always like to drink. There you go. And we usually sit down and get a better understanding of who the people are behind the business, right? Like the business is one thing, but how people operate and how they think is a completely separate thing. So, we like to sit down, have a good understanding of the sponsors, find out their past performance, find out who they are in the least pressure environment. Um, what I see the most amount of failure stem from when it comes to finding the right partners to work with, because that's really who we are for our sponsors and investors, um, is you do it while you have a live deal. You do it while you're in the middle of a problem or there's some kind of, impeding quick decision that needs to happen. We like to start well beyond that process so we can get a good understanding of each other where there's no pressure. There's no, we have to make this work. We have to do this. We have to do that. We can make very, very clear decisions. And when it's, the first flavor of potential sponsor or investor for us who is the the type of investor that's newer, they're eager to learn, they have cash, they have a good understanding of what they want to accomplish, they're really looking for education. That's really where we get like, the warm fuzzy feelings of working with those people help scale and grow because for us, we know they're going to be a lifetime customer, a lifetime client of our firm, and we're going to be able to scale as they scale. On the flip side of that, when it's a sponsor that really knows exactly what they're doing, we find just a good quality partnership because they have confidence to perform in what they do, and we can bring the confidence to perform on all the other aspects of the business that they can't. So it comes down to the people first. That's really how we assess whether we want to work with someone, and then understanding whether we can provide value and in which capacity we can provide that value.
I 100% agree. I believe every real estate transaction starts with someone, uh, who, not what. And I feel that too many people in our industry are focused on this guy has a high rise or a garden style multi or has a whatever. And underwriting, you can hire underwriters that can make your project look like, Blackstone is doing is doing it, or you know very institutional level, and every box will tick and will pencil. But really, when you know the person or who's behind it, that's to me the make or break. And uh, it's harder to put, let's say, into underwriting the sponsor. So I'm curious to what your process is. So you start to get to know them, you get to know them with a live deal, but everything is good then. How do you know how they're gonna react when
When things are
things
bad.
don't go well? Yeah,
Yeah,
which is
so
which is
we
100% of the projects. This is something that nobody understands really in real estate.
yeah,
Make a
the
plan
cool
and then it's never hit.
the plan is all right, where do we go when the plan fails and at what point is the plan going to fail?
Yeah,
Um,
exactly.
and so we look at it sort of like, all right, if you've been in the market space for X amount of years, um, show us before and afters, right? Like show us a little bit about what you did before. Let's look at your past portfolio. Let's look at the hangups that you had. Let's look up what you learned from those projects. Um, and then let's look at after, right? Like what'd you do going forward on other projects of similar quality and type in order to ensure that you didn't run into the same issues, right? So we love a proactive approach. We're not in the reactive business. If you're in the reactive business, you're better off playing on the public market side. We're very much only private markets. And so we assess through past experience. Now, when it comes to a sponsor that's brand new, and they might have some of the pieces of the puzzle put together, but it's not a very clear, articulable piece, that's where we step in to say, hey, lean on our experience, lean on what we learned from XYZ sponsor that does this very, very well. Lean on what we learned from this other partner that we have on the other side of the country that does these kinds of deals. And there's a lot of value in that. If you're here to play in the real estate space for the long term, you're not as worried about, you know, squeezing the most amount of juice from one deal. You're more so about learning and absorbing as much so that your next deal you can perform better and better. And it's about that small incremental win that compounds over time, not that one big win and then never doing another deal, which is like, a very scarce approach to investing.
Sure. No, and I'm with you. I see eye to eye, and I believe this is more smart capital, I guess, allocation than dumb capital allocation. And it's a very ugly term to say something is dumb capital, but when you have that cross-pollination of knowledge, a sponsor, I've noticed, they're very good, they're hyper specialized, they're very good at what they do. And even if they don't have all the parts, that we work with some sponsors that are best in class. And that's sort of our value proposition, is working with best in class sponsors. But even those are focused on their market, are focused on their problems. And we thought at the beginning that we couldn't bring something to the table to them. We're like, let's just be a sponge and listen. Like this is the guy who built, a town, like pay respects. But then as we were talking and we started to share, like, oh, we work with this other guy that's in the other side of the country, like you were mentioning, and there's this is what they see. They're like, this is so cool because you're
Yeah.
not only giving me money, you're providing access to knowledge and to other sponsors, because Coca-Cola is not going to ask for the recipe from Pepsi. They're not going to share that information, but when you're plugged into them, you're basically a conduit of information between both of them, and ultimately you're there to be a steward of capital to your
Oh,
investors, and
100%.
at the end of the day, everybody benefits from having a better project or deal. What can you share? What story could you share that you're like particularly proud of, or something that you're like, this was a big win?
I guess on our side, the biggest thing is breaking the barrier of traditional real estate investing. And what I mean by that is we are very much not your traditional fund. We're very much not your traditional real estate investment firm. Um, we look to really break boundaries and reallocate to a different way of doing business that sometimes goes against the grain. What I mean by that is a lot of times we get deal sponsors that come to us, they are interested in being in a deal. They realize that they don't know enough. And then they find out that, oh, there's another way that I could participate through deals by just being an investor and being on the LP position or investing in a fund, right? And a lot of times helping them understand that there's different allocations within a deal structure and the capital stack that are better fitting than being in the most proactive GP piece. Um, that really does resonate with a lot of people because the attractive thing to do is go put a deal up, put your sign in, say that you did it, whatever, right? Boast about it. But what more and more people tend to realize is that there's far greater profits in scattering your funds across other deals with the hyper specialized people than putting it all in one deal that you're going to potentially have a hard time with. Um, So where we find the most amount of like joy really comes down to just education and helping people find the best solution for where they want to invest. Because it's not just real estate; it's a people's business. Like real estate is a byproduct of us being people, and helping them understand where they could find the best returns for their style of investing.
Yeah, yeah, I 100% agree. Like you're talking to someone that this is why I started this podcast,
Hmm.
because most people believe that the barrier to entry is too high, which it is. It's very difficult, and I think that there's three barriers to entry, and I'm sure you're going to agree. First one is money. It's not a capital, like let me throw $5,000 to see if it
If it
goes
works,
well.
yeah.
The second one is knowledge. Most of these deals, even small ones, can be very sophisticated, and there could be various structures and waterfalls, and the devil's in the details. So you need to really understand what you're getting into. And then the third one is who you know, which is what you just alluded to. And I would add that who knows you. Like it's not only who do you know, but who knows you. And then, we'd love to get the call from the sponsor and says, "Hey, I thought of you. I thought this could be a good fit for us. What do you think? Are you like this is how we've gotten our best deals?" And but then the other side, which is what you're saying, is the education part. Is like, why would you be part? Why would you do this yourself?
Yeah. And the thing is that you can rack wins up and be a partner in a deal in a limited capacity to where you put your dollars to work, but more importantly, you get an education that other people don't get by being wrapped into a deal. You just don't have
Sure.
to go and try to figure it out on your own. And the thing is that, like we said earlier, like real estate is a contact sport, and like you can't be a one man team. Like you really need to have the right people around you to make something special. Otherwise, it's really just not worth putting the money, putting the time in if you're trying to do it all yourself.
Sure. No, absolutely agree. Like investing is tough.
Hmm.
I can't imagine developing, acquiring,
Yeah,
the disposition phase, like all of that is difficult. Finding debt, permitting, like all of that is like a world on itself. Like you need to know exactly what you're doing. If you don't know permitting and you want to land in a city randomly and you're like, hey, I'm going to build the greatest multifamily in the world or best whatever they need, and the county says no, it ain't happening.
yeah.
It ain't nothing's gonna move the needle. And I think that that's really why the importance to have companies like yours and mine, which is we connect those dots, we simplify the process, and then we also eliminate what doesn't work. Because I think that there's a lot of stuff that can get done, but doesn't necessarily make sense.
I think the 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 amount of tools that are available to developers and investors that don't get used but get talked about all the time is like astounding, right? There's so much like talk about, oh, we're doing qualified opportunity zone funds a couple years ago, and it's like all this money got poured in, and none of those projects really, scale and grew to the capacity that people thought they were going to. And there's always like a hot button, hot press topic, and everybody wants to run to it and kind of build from there. And you can get lost in it, right? Like the real old school developers and investors that have been in for cycles and cycles and cycles understand the core fundamentals, and the faster you can get aligned with those people and understand, what are the fundamental pieces and building blocks for an investor, the easier it is to really review and analyze deals without getting lost in the new fancy term, the new fancy capital strategy. That only works for a very small cycle of the market.
Absolutely. And it goes with product as well. Like that applies to product. Like everybody today is chasing the data center model, and then it just it just doesn't work for the retail investor. Like that's a space, that's a scary space. If you get into that, it's pretty scary.
Yeah,
One
you're better
mistake, you're
off.
out.
Yeah, you're better off removing yourself from being the direct sponsor and moving into like a REIT, a private placement, putting it in the hands of knowledgeable people that get access to the best quality deals and can move the fastest, rather than trying to compete in that space with them.
Exactly. And even knowing how to choose them, because I think there's the
Yeah,
hype of, let's say, data center right now, and then there's like the opposite end of the spectrum, which is downtown office.
yeah,
Like people are like, I wouldn't touch that with a stick. I'm like, nothing is created equal in real estate. I think what I've learned over the years is that nothing's at face value. Like we see decks that look like garbage tend up to be the best projects. Or you think this idea, like this downtown office idea, which is things that people are like, oh, it's the worst because people are not going to back to work. Yeah, but there might be a suburban office that is crushing it and is doing really well. So it's like having the patience to go beyond the superficial and making sure that it's worth it or not. And then the same thing goes with like the data center. There could be an entrepreneur that says data centers are the future of real estate because the AI and uh, the demand from data is so enormous that it's really good. And then you think, oh, of course, that makes 100% sense. But are they the ones that can execute on this? Have they done it in the past? There's a lot of disconnects, and I think it's really
Or
important to not.
saturation, right? Like
Yeah,
saturation is
yeah,
a big part of adoption, right? Like you could have a ton of downtown office space that might be vacant because of COVID. Now you have Fortune 100 companies that are looking to move back into these long-term tenant spaces. But then you might have thought, hey, I'm going to go do a office to multifamily conversion, which is happening. Or you might be in a place like Sterling, Virginia, where you have so many data centers coming in that now we're getting limited mandates on how many data centers you can put up, right? Or like no more fast approvals for specific zoning or rezoning of areas. So you got to catch the right wave if you're moving with trends. But if you're always in a specific part of the industry, then you just need to understand that it's a cyclical market, right? So you could be a great multifamily developer in the worst time to develop multifamily, still find great deals in other markets, and then just bear the market out until you're back on top. Um, so it's about picking a strategy and kind of sticking to it, as opposed to just moving with trends, unless the goal is to move with trends, in which case you need to get really good at being a trendsetter and finding out who is driving the market and aligning with them.
for sure. Going with that, or along those same lines, what do you think are mistakes investors are making now, other than trying to follow the sexy, which is, I think, the one
Yeah,
that
I think
always is
that's
like a
for
mermaid.
always.
Everybody
Yeah.
loses money in that.
Yeah, I think definitely following. I mean, besides that, it's kind of hard to say, right? Like most investors that I see that fail invest in things they don't know, invest with people they don't know, and invest in projects that they are overconfident in. Um, so when they invest in projects that they don't know anything about, it's usually because they hear from other people, hey, this is doing well. I know one person that's doing this. Or, the market is really saying this is where we're going, so I'm going to invest in that. When they invest with people they don't know, they don't take the time to create the right due diligence for even saying, hey, I would love to place money with this person. They don't know what a due diligence documentation or checklist would be to even vet a potential co-GP or GP. And so they just say, hey, like, I like this person, so I'm going to move forward with this. Or they might have a track record, but there's really no insight or vetting process. Or the worst part, like I mentioned, is that they go out to market, they find a trendy piece, or they invest in a project that sounds good on paper, but they don't have the capacity to actually see the projects through. And they get overconfident and they say, hey, like, these pieces are easy. I might not know X, Y, and Z, but I don't need to look at it until we get to that point. And then they get to that point and can't figure it out. So they play a reactive role in their own investments as opposed to proactive. Those are the three main components that I always see investors get caught up and hung up on. Whether it's a seasoned investor in one line of business that's moving to a new line, or someone brand new in the space and they're just trying to get things figured out. That's usually the hangups. Like if you can't be confident in making decisions and finding the right people, um, it's hard to have projects really come together.
For sure. I would add impatient capital is also
Yeah.
the biggest hiccup, I believe, in illiquid markets. So I agree. If you don't know what you're doing, and I definitely want to get into what is your due diligence process, what is like some tips that you can give people uh, of how to vet essentially a sponsor that you don't know or a investment management company that you don't know. But I do think that, as you said, most things are cyclical, and nothing goes to plan usually. So hitting milestones can be better or worse, but you need to be understanding that you're on the same boat and sort of you have to get to the destination, but it might take longer. It might take shorter. And this is where non-seasoned investors get a little bit angsty and perhaps, don't understand. So what would you tell those investors about being patient? And then we can go on to the
Yeah, I think that's probably the hardest part of being a good investor. It doesn't matter whether you're investing in real estate, stocks, public markets, private markets, um, impulse control, right? Like knowing when to actually say yes and go 100% in versus knowing when to say no and it being a quick and easy no. Um, so I think that when it comes down to having that impulse, it's kind of a byproduct of building confidence. Um, and good quality confidence as an investor isn't just your ability to say yes or no on specific decisions within a deal, but understanding, okay, here are all the problems. Here's how I feel about these problems. Here's what decisions need to be made. And then just going out and doing them and not dwelling. Because what I see a lot of impatient investors do is they ruminate on the problem rather than try to seek solutions. And they don't find knowledgeable others to really bounce ideas off of. And they get caught, in a echo chamber of other people that have a lot of uncertainty, and then they never actually drive the right decision. Um, and usually, what happens is enough time goes by to where they lose favor in the deal because they've allowed time to be the justifying factor, right? Like no decision made is just as bad as making a bad decision. So the faster you can get to all the problems that you need to understand, and the faster you can provide potential solutions and look for the worst possible outcome that you're the happiest with, the easier it is to be a good quality investor, sponsor, deal maker in any space that you deal with.
like how you expanded to any type of investor.
Hmm.
And it reminded me of a quote of Warren Buffett that says, the investing is where the impatient lose money, or where the impatient investors go to lose money, impatient investors make money. And the way that you put it, it's very true. It's like, I actually believe that becoming an investor, you need to make a conscious effort to be patient. It's a decision. It's not an indecision, like you mentioned. It's not like, oh, let's not do anything. It's more like, what am I doing to be more proactive? But it takes a different type of approach than the operator or the entrepreneur. Like it's not like you can in real estate is like it takes time. So you can't really say like, oh, let's adjust our business model because we're not going to hit our numbers. It's like, let's meditate, let's make sure that this is happening, and then once we do this shift, they take a long time to shift. It's not short term in real estate. I think is like a year. So I think that takes a certain level of decisive approach, and then letting go as well. Like you were just mentioned, like let's take the decision and then let's let go. Because if we every day try to move the needle, we can like oversteer. Like imagine a big
You
ship
ran out of fuel.
and run out of fuel. Exactly.
Yeah. I mean, the biggest thing is like, um, it's hard for a lot of people to grasp that, all right, let's say that you're an investor starting in your 30s and you have runway for potentially, another 30 to 40 years. If in the short term, every season is a year, you really have 40 seasons of playing the game to figure out how you're going to make something work. And if you blow past the first 5 years on bad investments, you're going to spend another 5 to 10 years recovering, and then you're really never playing the game. So, what a mark of a good investor that I've seen that builds out a huge legacy and then builds out a great succession plan for that to carry over and really see compound returns is being patient up front, understanding up front. Like, you don't need to do a deal just to do a deal. There's a million other ways you can lose money. It doesn't have to be in, deal making. But in order to make great returns, the more patient you are with understanding the full body of what you're doing and being comfortable with the uncomfortable pieces that you might not know, the easier it is to really start to calculate, measure, and scale your wins. Like you can make small incremental wins, but as long as you're constantly winning and that's scaling, that's the value of real estate, right? Whether it's appreciation, depreciation, cash flow, value add, ground up, repurpose, reuse, whether you're investing in notes, aggregating notes, buying non-performing loans, like the game is the game is the game. As long as you understand what you don't understand and can make decisions based off of the people that are around you, what you're comfortable with losing, then you can start to carry those wins. But you never want to put yourself in a position to where you hop in the game, not really know what you're doing, really feel uncomfortable about making great decisions, and then set yourself so far back that you can't actually play.
Exactly, exactly. I love that. That was I agree again with what you're saying. I think that we've been around enough to know that how things can go sour very quick if you don't know what you're doing, and then if you do know what you're doing, all we want is consistency. Like that's something that we kind of look for in our investment committee is to us consistency is a superpower, whether it's 8% returns, 10% returns, 12% returns, like it doesn't matter as long as you're consistent, because that consistency is what drives the legacy. That's the superpower. It's the compounding effect. There's nothing more powerful than that. You don't need a huge win. You don't need to make 40% in 1 year. Like that's great if you can get it once, but if you bank on getting it twice even,
Yeah.
you might set yourself back 10 years. And like what you just explained, how you can have like if you see yourself as 40 seasons, but if you lose in one season a lot, it's like you cut your season by 25%.
Yeah, your overall seasons, you're not playing.
You're
You're not
not
playing at
playing,
all.
and then you kind of get sour too, because I've seen countless of investors are like, "Oh, I lost money doing this fix and flip," and I was like, "Why did you even get into that?" They're like, "Oh, but everybody else was doing it, so it seems so easy." Or now the other one that I criticize heavily is the Airbnb investment. I'm like, "Why did you get
Yeah.
into this?
Short-term rentals.
Why did you get into a short-term rental?" "Oh, because I have such a big salary I can mortgage, and then from the mortgage I could pay." And I was like, "But you thought it was going to be a control remote, like remote control uh, investment? It doesn't work that way.
Yeah.
Nothing works that way unless you go with like a real passive investment in a passive position where you have a little bit more control and less ownership." This is something that I've discovered also myself. It took me a while. Let's go back to like your DD process. Uh, let's say someone is starting out. What do you suggest they do, or tips or tricks, something that can help them with a back of a napkin say, should I look further or should I let this one go?
Yeah. As a potential LP or as
As a
like,
as a someone that wants to invest into real estate.
got it. Um, I think the DD process looks a little bit different if you're analyzing a deal versus analyzing investing in to a deal with someone else as an operator. So if we're talking about investing into somebody else as an operator, which is what I think a majority of people should do, to be quite honest with you, um, the process really should look like, have I met this person? Have I seen the project? How much of this project do I not understand that's been presented to me? Is there an opportunity for me to meet other people that this person's worked with and actually find out what their experience was like? Because not enough people do that. It's surprising to me how many people will cut a check and not ask about, can I get a reference of someone that you worked with in the past? Um, and a lot of times you'd be surprised whether you're talking to new lenders, whether you're talking to new sponsors, whether you're talking to anybody in the real estate space. When you ask for referrals and they don't have anybody to tell you, it usually tells you that they haven't been doing it for very long, or they have been doing it for very long and they've burned a lot of bridges, and you probably shouldn't work with that person. So referrals are a huge portion of getting a clear understanding, where you don't have to spend a dollar to find out how somebody works when you can just ask other people how they've worked with that person, because they've already made that investment. And if it went very well, they'll tell you, I'm sure, all the great things. And if it went very poorly, I'm sure if you just bring up the name, it'll kind of speak for itself. So that should be a part of every potential LP's repertoire when it comes to due diligence. Beyond that, I think it's always good to seek, third party counsel. There are a ton of these newer advisory shops that advise LP investors on how to make great investments with good dedicated GPs. And I think it's always good to get a second set of eyes on a project that you might not fully understand. Um, because the worst that can come from it is you saying no and protecting your capital.
That you didn't say the first thing you need to do is learn underwriting, or the first thing you need to do is learn, like, understand the model. Even though the model for me is like the most revelatory, it's like a revelation of who someone, how they think. And it's not, it's like forensic accounting, but it's like forensic investing. Like when you look at someone's model, you understand how sophisticated they are, how they're thinking, if they're too optimistic or if they're negative, if they've stress tested their model. All these things are very telling. But I like that you took an approach that was more direct. It's more practical. If you want to vet someone, you do it very quickly this way. And you know how a lot of people say it's like dating. You kind of like, you got to meet the person, you need to see them, you need to go to the project, you need to uh, really like it. Although I do think that's very good, it's also a way to involve emotion into your decisions. I'm I'm faulty of this. I know this, and I talk from experience. I fall in love with projects. I fall in love with neighborhoods. I fall in love with sponsors. Even I'm like, this guy's gonna crush it. It's so cool what he's doing, and these deals that he's working on is really gonna change the neighborhood. And I kind of like fall in love with that narrative. So I think that even though I agree with you, I think you need to be cognizant that you might fall into the lines trap, essentially.
Yeah, it's a balance, right? So like on one side, you really need to understand, do you know, like, and trust this person that you're going to give money to? On the flip side of that, if you know you don't know enough to be able to evaluate the financial model, do you have a third party vetting source that's unemotional?
Yeah,
There's no
yeah,
emotion tied to the project to be able to say, hey,
for
you
sure.
know, here's some things that you need to find out about. And I think that that's probably the best way to keep a balance, right?
Absolutely, absolutely. And I love that consultation set portion, because that's how you separate emotion from decision,
Yeah.
is by just calling someone up and saying, You'd be surprised. This is something that most people don't know. It's like pe- people in this industry are deal junkies. We want to know what's out there. Like if someone calls me and says, "Hey, I have a deal," I'm like, "Please tell me about it. Tell me the story. How did you find it? How do you come about it? What's what's the how did this come about? Is it ready to
Yeah.
is it shovel ready? Are you ready to acquire? What's the debt like?" Like I love that stuff. So I agree with you that uh, reaching out to people and just saying, "Hey, can I pick your brain for 15 minutes?" To the person you're picking the brain, it's like a huge ego boost, because like, thank you for
Yeah.
considering my opinion. But also it's super enriching to understand new deals and what's out there, because it also gives you a pulse. It gives you like,
Yeah, a
what
good
are people
understanding. Like, oh,
looking.
why is this 150 million? Like, why is this 150 unit going up next to this other project that a buddy of mine's doing?
Yeah,
And it's
like
like, am I evaluating the space wrong?
it's like
um,
it's like when we started saying, like, when you once you understand this industry, you kind of can't see anything else. I live in Brickell in Miami, where you have 19 towers coming up, and most of them are more than $1 billion developments. You say, how can there be like 15, or I don't know, at least $15 billion of developers, one next to the other? And in my small mind, I was like, I'm sure they have super sophisticated guys, seasoned guys that understand that putting $1 billion tower next to another $1 billion tower is not going to. And I'm
right, it's
like,
not going to pan out.
how are they doing that? It's that like supply and demand, and something's gonna shake, and then you start digging deeper, and you're like, okay, now I get it. Now I'm like understanding how this works and why can there be so much.
But that's the beauty of it, man. Like
Exactly.
everybody plays to their own set of rules, right? Like
Yeah.
a
Yeah.
good deal for one sponsor might not be a great deal for another, but if the objective of that sponsor is on a different timeline or for a different use case, like, that's kind of why as an LP or an investor in any deal, you really need to understand what is motivating this potential deal sponsor to do this project. If it's just money, what is the outcome that they're looking for? If there's other, you know, byproducts of doing this deal, like does it align with what my goals are?
Yeah. Yeah.
Because, that's not always the case and decisions are made on the fly. And if you can't get to the like pain point of why that investor is even trying to solve that problem, why that deal sponsor is trying to solve that problem, you might think it's because of one reason, and midway through the project, it goes in a completely different direction.
And you touch on something super important right now. It's understanding from their perspective, like not from your perspective.
Yeah,
Because,
no.
like I said, from my small mind, I was like, oh, this doesn't make any sense. Like something's going to give, there's going to be a crash. But then when you start looking at a project from the sponsor's perspective, you're like, this makes perfect sense. They have the best sourcing of materials. Their costs are super low. They have infinite financing at incredibly low terms. They've pre-sold their tower for 50% at 50% deposits. Their equity is already covered. They have like, all these things you start to say, okay, if I was them, I would do it too. But if you
Right.
don't know it from their perspective, you might stay on your side, on your perspective, and stay and keep on like, kind of criticizing others instead of like catching the wave, which you alluded before, like,
Yeah,
being in their side.
100%. And the thing is, for us, a primary bulk of what we do is debt financing, right? Like playing on the capital stack. And so for us, understanding that you could have two projects side by side, and if we had to pick and choose which project we're going to fund, um, we want to fully understand what the mindset of the GP is that we're going to let borrow the money. Because a lot of times, the projects could look identical, experience could look somewhat the same. It could, vary, but the outcome could be completely different just because of what they're looking to do as they run into hurdles. So it's not just about deploying patient capital on the lending side. It's also about understanding, all right, all these deals have some kind of problem. And there's a reason that they're coming to a private lender as opposed to a bank. And so we need to have flexible and common sense underwriting solutions that mitigate the risk for our investors, and at the same time, still help this project move forward.
I
Right.
love that
So
you
it's a balancing
touched
act.
debt financing because I think this is like, at least in my experience, something that's the least understood by investors. Like most investors only understand ownership, equity, but we also have a private credit fund. And the hardest part wasn't finding deal flow because obviously deal flow right now is there's a huge opportunity for it. But the investor base is still like I'm going to invest equity into a debt vehicle.
Yeah. Right.
That's like they're like, so are you a bank? And you're like, well, it's a private lending fund essentially. How do you bridge that education gap, or are your investors usually more sophisticated?
So we have a mix. We're a Reg D fund. So everybody that places has to at least be an accredited investor. Um, a bulk of our investor base is made out of self-directed IRAs, solo 401ks, Rob accounts, basically rolled over retirement accounts. Because a lot of people don't know that you can take your retirement accounts and actually have a custodian allow you to make investment decisions to where you're not, placing money into a public account and having Vanguard or Fidelity basically eat up all those fees. But you can actually take control of your retirement, and all the same tax benefits apply, and you can allocate that into real estate. And so, for us, a big portion of what we offer is helping our investors understand, hey, you're in the safest part of the capital stack on this project, right? Like we're issuing debt on this deal. At the end of the day, real estate is always collateral. If the deal doesn't make sense, somebody else is placing the equity into the project, and we have the ability to take back or work with that sponsor on the collateral on that piece of real estate if things don't go well. And they also understand that they're investing in the fund, which places their assets across a wide range of properties. So, um, it gives them a sense of comfort, understanding if they're still playing in the real estate game, um, and understanding that it's still tangible, right? Like most of our investors like to see and touch and like be a part of the transaction as opposed to investing in stocks and bonds, things that they can't see and touch. So the education piece really comes into play when we help them understand that it's a diversified pool. They're in the safest part of the capital stack with real estate being the collateral. And we have the ability to churn that money, which obviously gives them more and more returns, which is, for a lot of them, they're like, wow, I didn't really understand that you can issue capital at X, sell the loan or aggregate other loans for Y, and then produce returns for us as investors. And on top of that, if a deal doesn't go the way that we want it to go, if the fund manager, the origination channel did a good job in putting a deal together that's safe, you always have access to tap back into that equity that that investor placed and get a second go at that same project.
Yeah, yeah. I when I said once you learn the real estate game, you never go back. But once you learn credit, it's
Yeah,
like
banks never lose, funds never
it's
lose.
like why did I ever go, like, I understand certain equity investments are out of this world, and they're wonderful. The sponsor really delivers, and you can crush it. Like it's the best. But then when you understand credit, you understand that it doesn't have to be the best anymore. The underwriting of, even though there's a little bit more extensive underwriting, your last dollar exposure is so low sometimes that you're like, it's I wouldn't say almost impossible for you to lose money, but you have what you just mentioned, optionality. You
Yeah,
have various sources of how to fix the problem. And it's almost like rain or shine, you get paid. So that's
yeah, it's
like
just gonna,
the beauty
you
of
get paid today or you get paid, down the road, but
down the
the
road.
money's still coming.
Yeah. But then
What
if
what
you
I
get down the
always,
road, it's like at a
yeah,
very attractive basis, which is the
yeah,
best
pennies on the
decision.
dollar.
Yeah, exactly.
Yeah. So the way I look at it and the way that I always tell investors is you're either trading promises on the equity side or you're trading material because you're viewing money as material that goes from one hand to another. And when you really boil down to finances, lending, dollars, um, it's a clear choice. Because if you're unemotional as an investor, um, the debt side of things, the debt business is very, very lucrative. If you're more emotional and you like to play on that side, then you know the equity side is great because you can say you have direct ownership in XYZ.
I, I
Um,
I agree with you. I think it's
mhm.
like I wouldn't say like emotional, I would call it ego.
It's definitely an ego thing.
Because you can say I own that building, but when you lend, you never say that. Like the bank doesn't say, that building 70% is ours. It's like
Right.
they're just like, they never say this.
Yeah, and they own the majority of it,
But
which is
not
the
only do
crazy
they
part.
own the majority, they control the asset
Yeah,
because they
100%.
dictate the covenants. You don't hit it's not only you don't pay the interest, you don't hit covenants, you can get wiped out. And that, the control aspect. That's why I'm like, uh I'm glad that you took the conversation to this side, because I think it's the more obscure side of real estate investing. It's like, why are you dealing with equity when you can go into the debt space? It
And
is a
earn
lot
comparable returns is
comparable.
the
And
thing that
right
people don't
now,
understand.
I think overperforming and definitely beating equity. I think it'll invert itself.
Yeah, equity markets are drying up. and have been. But like you mentioned, I mean, there's a huge uptick in private credit funds. Um, the biggest differentiator is what happens next, right?
Yeah,
Like,
yeah.
what happens when the deal flow dries out? What happens when um,
Saturation.
regional and small banks are comfortable with commercial credit again? What happens when, all of these changes come back into play? And is the fund that you're investing in a lockup period that allows you to diversify? Or is the portfolio you're investing in, does it have a strategy to pivot when we get out of this market cycle? And again, more questions that LPs should be asking that they don't always tend to do.
Yeah. And I think that's why they they should work with people like us. Investment managers are the ones that have the pulse of the market. Like we are thinking, okay, the debt curve inversion already corrected itself. We're already on positive space, like how it should be. Time value of money is again the right way up, and but you still need to think, okay, if rates are going to come down, how is that going to affect your private credit strategy? And I'm always like, I'm not Blackstone. I'm not a bank. Those are the guys that are going to be affected because they are doing volume plays. The volume is going to be lower, but if you cherry pick, you can still find very
Yeah,
creative solutions. You can find very complex things that require a higher rate of return because of the complexity there is in the asset, and that takes someone like us that understands a Frankenstein or a hairy deal that it's actually not that
right.
hairy, it's more like you just need to understand real estate.
Yeah, no, 100%. And having the capacity to play on both sides, like sometimes it makes more sense to be a direct lender in the primary market and lend directly to the sponsor. Other times it makes more sense to take your same vehicle and go aggregate loans from direct lenders and play on the secondary side of the market where there's more liquidity. So, a strategy that's all encompassing, that's taking into account different market cycles, like those are usually the best ways to go because you're not limited, right? Like there's no mandate that says I can only lend in this capacity. It's but it's harder because you really need to trust the fund manager and trust the people behind managing your money.
Yeah, yeah. But still, even though the trust is there, it's if it's not, I think personally, this is my opinion, I would start in, if I wanted to start again, I would start doing credit because there's less things that
Oh
can
yeah,
go wrong. You're better at you're higher up in the cap stack. If there's a highly diversified fund, even better. If your returns are lower and you're like, oh, but I'm just making 8%, I'm gonna be like, you're at least making 8%. You're not in the other
right.
side where you're like, I might be wiped out
Yeah,
any day.
yeah. It's a constant roller coaster, and like weather, weather dictates your returns. Zoning dictates your returns. Other people in the ecosystem. So it's tough.
Yeah. This was wonderful, Isaac. Thank you so much for being
Yeah,
here.
thank you.
This was very refreshing, and I think we're very, very aligned. So definitely want to continue this conversation and then pick your brain and show us deals that you're looking at, and
Yeah, of
we'll
course.
do the same. So I think we're thinking along the same lines. I do like to finish the podcast by asking everyone that's on that what inspires you to the work that you're doing right now.
Man, for me, it's community impact. The way I look at real estate is it's something that the more education is put out, the more investment dollars roll out, the more the people that live in the real estate that we help develop, their lives change, the sponsors' lives change. Um, it's like a very giving industry if your eyes are open to the changes that you make
Yeah,
and the quality of life that you impact.
for
So
sure.
for me, that's what it's all about. That's why we have a smiley face as our logo. That's why, bulk of what we do, we try to involve community impact as part of a byproduct of us making great investment decisions. So that's the biggest thing for me.
For sure. For sure. I like your answer. I think this is a very financial, transactional world, very much deep in the sheets. But then when you see the asset, uh, and then someone lives in it, and they tell, or you might hear that they're very happy there. You're like, you know, from my little computer, from my desk, you impacted that, and that's very rewarding. So I
It's
definitely
it's not even
align
just
with
that.
you.
It's also like you know, the individual investors that don't really like there's so much opportunity to invest in what we do, especially on the private credit side, that people are just unaware because there's not enough education out there for it. So seeing how big of an impact that can have on the investor over time is incredible. So the it's end to end. It's awesome.
For sure. I'm with you. Awesome. It was great having you here, Isaac. It was a pleasure meeting you, and let's continue this conversation offline. I think this is the start of a good friendship, and
Of course.
congratulations on everything that you've done,
Thank you. Awesome. Thanks for having me.
for sure.